All right, welcome everybody to the next class. Here we're talking about structure and institutional order flow. Right, we're talking about trends, how to identify the trends, how to interpret the information on the charts, candlestick anatomy, and premium and discount zones. These are the things we'll be looking at in this class. I'm going to make the class as snappy as possible. All right, now when you look at the charts, you see, like I said before, the charts, the market price does not move in straight lines, more or less like zigzag, but they always have direction if you know what to look for. What we're looking at right now is an example of a ranging market or a whipsaw market or a sideways market. This is what you see. You see the market is generally just moving to the right, generally moving in the direction to the right. And then there's a downtrend or the bearish trend. The downtrend or the bearish trend has a movement that is akin to what we are seeing right now, generally moving downwards to the right, so sloping downwards to the right. All right, okay. And then we have an uptrend or a bullish trend. For uptrends and bullish trends, or uptrends or bullish trends, we have price moving in an upward slope to the right, an upward slope to the right. There are several ways that information regarding price is represented on the charts. We have bars, we have line chart, we have Japanese candlestick, and we'll be focusing on Japanese candlestick because Japanese candlestick gives the most information about price movement. The most information about price movement is given by the Japanese candlestick. What you're looking at is a bullish and a bearish candlestick. Let's look at the bullish candlestick. The candle has a body, which is from the open to the close of the body, and it has wicks to the downside and wicks to the upside. Call it an upper wick or an upper shadow, and the one below is called a lower wick or a lower shadow. Bullish candles signify an upward movement in price. So say you are on maybe a 1 hour time frame. Every candlestick on that 1 hour time frame took 1 hour to form, right? For this example, the chart is on a 2 hour time frame, so each of these candles took 2 hours to form. Okay, now what that means is that the candle opened right down here, started here at the beginning of these 2 hours. The candle, the price was here, the price of this asset was here, and over the 2 hours the price of this asset somewhere within the 2 hours came down as low as this point here, the end of the week here, and still within that 2 hours the candle at some point was, price was all the way up here within the 2 hours, and then finally candle closed here. So a bullish candle opens below and closes above. All right, we have the body of the candle, we have the open of the candle, the close of the candle, and then the wicks of the candle as the high, and that right there is the low. If we look at the bearish candle, it's the exact opposite of the bullish candle. The bearish candle opens up closes down, right? So let us assume this is a 1 hour candle. At the start of this 1 hour, price of this asset was here. Somewhere within that 1 hour, the price of the asset was all the way up here. And before that 1 hour was over, the price of this asset was all the way down here. But by the time the 1 hour was over, this asset's price was right here, closed here. So the bearish candle opens up, closes down, and then we have the high and the low. So that is it about candlestick anatomy. You need to have complete understanding of these things. Now, when you look at your charts, you should generally be able to tell that, okay, this is an uptrend or a downtrend or a ranging market. How do you know what the trend is? Is it sloping upwards or sloping downwards or just going in a straight line to the right? This case, sloping upwards. In an uptrend, we have what we call highs and lows in the market. In an uptrend, price is gradually sloping upwards, and in so doing creating higher highs and higher lows. I'll say that again. Price is creating higher highs and higher lows. If you look at this chart very well, you see a low, you see a high, you see a higher low that is higher than the previous low, and the next following is a higher high, right? So low, high, higher low, higher high, higher low. This is a low, but it's higher than this low, so it's a higher low. And then a higher high. This high is a high that is higher than the previous high, so you have a higher high. It might sound confusing right now, just stay with me. You will get the gist the longer you expose yourself to this information. So don't run away, don't get confused, okay? Just take it as I'm giving it to you. Higher low, higher high. Okay? Very, very simple. In a bearish trend or in a downtrend, we still have highs and lows, but this time, since price is sloping downwards, we're going to be having lower highs and lower lows. Lower highs, lower low. Lower high, lower low. Lower high, lower low. Lower high, like that. That is how to know that the trend for a particular asset is a downtrend. You have lower highs and lower lows. Then when it comes to the ranging or sideways or whipsaw market, you generally have seemingly equal highs and equal lows. Okay, so it's just generally moving to the right in a straight line. Right now, you would not see this picture perfect on the market, but when you look at it, you will be able to tell that the market is just ranging, or it's just moving in sideways. Okay, moving in a sideways direction. Now, what do you see? Uptrend, right? Beautiful. You were right. Yes, it's an uptrend. High, low, higher high, higher low, higher high. You know this is an uptrend. Okay, that is how to determine the uptrend. Just look at the highs and the lows. Is it sloping upwards? Is it sloping downwards? Or is it just moving in a sideways direction? What are we looking at? Another uptrend, right? You have the high and the low, a higher high that is higher than the previous high, higher low that is higher than the previous low, higher high. Another higher low should be forming somewhere around here. Okay, so that is the idea. What are we looking at? Another uptrend. Okay, so just look at the structure. This is what we call structure, the highs and the lows. Okay, so we have the higher high, higher low, higher high, higher low, higher high, higher low, like that. You know this is an uptrend. And when it's an uptrend, what do you want to do? You want to buy. Trust me, you don't want to sell, especially if you are a newbie. You don't want to sell in an uptrend. In an uptrend, you want to buy. In a downtrend, you want to sell. And then the sideways market, you want to either stay away or be a scalper. We'll talk about all of that pretty soon. Now, what do we have here? A downtrend. We have lower highs and lower lows being formed by the charts. Price is making lower highs and lower lows, right? Next example, another downtrend. Price is making lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. Now price has just left an uptrend and has begun a downtrend. The most recent trend here is a downtrend. Lower highs and lower lows. I believe you get the picture now. How about this? So ranging market, right? Like I said, you will not see this picture perfect, so you will not see exactly equal highs and exactly equal lows. But like I said, once you look at it, you'll be able to tell, okay, this is seemingly equal lows and seemingly equal highs. It's not exactly in the same position, but the highs and the lows are forming at about the same price levels. Okay. What do you see? Sideways market, right? Sideways market. Equal highs, equal lows. Now let's talk about premium and discount zones. What is a premium zone? What's a discount zone? And how do we use them? First thing you want to know is the trend. What is the trend for the asset I'm looking at? Okay, it's a downtrend. Beautiful. Next thing you want to determine is your range. What is the range? Where is the most recent high and the most recent low? Look at this example. Assuming that all of this had not happened and we're looking at just this high to this low, that will be your range. This is the high of the range, this is the low of the range. Once that is determined, you pull up your Fibonacci retracement tool. All right, pull out your Fibonacci retracement tool. We'll talk about that when we're talking about navigating TradingView. You pull out your Fibonacci retracement tool and set it to determine where the 50% of the move is, and then you pull the fib from the high to the low of the range. Anything above 50% in a downtrend, anything above 50% in a downtrend, you can begin to expect price to drop from there. As far as we're in a downtrend, price is going to respect the structure that is being formed. Then once price gets above 50%, you can begin to look for sell opportunities. And let's look at what happened. Boom, price got into that 50% level, above the 50%, and dropped from there and kept dropping until it formed a new low that was lower than the previous low. Using the same asset, the next high and low, from where I just talked about selling, take that as the new high of the range and the low as the new low. Pull up your Fibonacci retracement tool, mark your 50%, Anything above that 50% is your premium zone. You want to sell from the premium zone. You want to sell at premium. Okay, so like I said, in the downtrend you want to sell. So this is a downtrend. We're looking for sell opportunities. We're looking for the sell opportunities in premium zones. Premium zone is 50% and above, and price comes into that 50%. You sell and it drops below the previous low. Same thing. Determine your range, pull up your fib, check what the 50% is, and price just enters the 50% a little and drops, creates a new low. Okay, now for a bullish example. So the price is clearly in a bullish trend. What do we see? Determine the low and the high of the range. Pull up your fib. This time from the low to the high. You pull your fib from the low to the high. Check out your 50% and look at that. Price just tapped it a little and zoomed off. Right? That 50% and below is called your discount zone. Right? And then we look at it. Determine the range. This is the low of the range. This is the high of the range. Pull off your fib from the low to the high. Whereas your discount zone, 50% and below. Price just taps that 50% and zooms up. So we'll be looking for sell opportunities anywhere, or for buy opportunities, I beg your pardon. So you'll be looking for buy opportunities from anywhere below the 50%, and you buy opportunities anywhere below 50%. That is your discount zone. That is where you want to buy from. As traders, we have a saying: you buy low and sell high. So when the market is trending upwards, you look for the nearest least amount you can buy at, and when price is trending downwards, you look for the nearest highest price you can sell at. That is how it works. Thank you very much for being part of this class. If you have any questions, please feel free to send them in and let us tackle them. Thank you and God bless. See you in the next class.